Okay, ladies and gentlemen, what we're looking at right now then is an FRQ from 2009 that is going to take us a step further from our notes the last several days. The last several days we did banking reserves. We talked about required and excess reserves. We did the multiplier. And we did this with a mathematical grid, so it was an easy approach. We reminded about our tools for the Fed. And we talked about what the Fed was. We talked about required and excess, money, M1, M2. And then we talked about the concept of changes in the money supply versus what a bank can do. And so now we combine all of these concepts into an FRQ from 2009. The FRQ from 2009 says that assume the reserve requirement is 20% and banks hold no excess reserves. No excess reserves mean that the bank is what we call loaned out. That's a good thing. That's what banks want to be. This right there is an indicator that we need to hear when we get a problem like this, because in order for the multiplier math to be true, the bank has to lend all of the excess reserves. So what that means is that if all the excess reserves get lent, then we can multiply and it will give us the full appropriate answer. What they're saying here is that this bank is lent out, which means that the multiplier is in play. The multiplier will work. The multiplier is going to work to the fullest extent. They will always put that in there because that's their way of saying use the multiplier, and then you don't need to worry about any wonky math. So next then it tells us that assume that Kim deposits $100 of cash from her pocket into her checking account. Calculate each of the following. So remember that a checking account is a fancy way of saying demand deposits. There's our vocabulary again. So then number A1 says the maximum dollar amount that the bank can initially lend. That means that they are talking about this bank. Commercial bank is just like your local corner bank. This first question is saying this bank versus the system. That's a this bank question. Since it's this bank, that means we don't multiply. Don't multiply. How much can this bank initially lend? That means they want to know what will this bank's excess reserves be as a result of this $100 deposit. Now remember, they had no extra money already. So before she deposited, her excess was zero. But then Kim deposited $100 of cash. The cash goes into the bank. The bank immediately wants to lend it, but the question is how much of the 100 can the bank lend? The reserve requirement is 20%. The reserve requirement tells us that we have to keep that money on site. 20% of 100 is $20. So the bank has to keep $20 on site. If 20 of the 100 has to stay on site, that means the excess is going to be $80. How much can this bank lend? $80 is what they are going to be allowed to lend from this initial deposit. When we did this yesterday, what we saw was that we had the question of a $20,000 deposit, X amount had to stay in site as a function of the reserve. And then of the $20,000, then how much was the bank allowed to lend? That's what this question was asking. We had to find 20% of the 100 to see the required. And then the remainder is called excess, aka loanable funds, and that was $80. So A2 says the maximum total change in demand deposits in the system. Okay. When we are talking about the system, that means then that we have to use the multiplier. This bank means don't multiply. That's very cut and dry. This is a multiplier question because it's talking about the change in the banking system or change in the money supply. So we have to multiply. So in order to determine this, we have to multiply. That means we have to find the multiplier. The multiplier, I'm going to just move down here to show you. The money multiplier equals 1 divided by the ratio. In this problem, they tell us the ratio is 20%. That means then that the money multiplier equals 1 divided by 20%. Now, you can't do that. That's not real math. That means you have to go 1 divided by 0.2. You have to convert that to a decimal. How many times does 20 cents go into $1? The answer is 5. So for the duration of this entire problem, the money multiplier equals 5. Now, me personally, when I'm taking an AP exam for fun, and I take the AP exam for fun every year, I would have immediately found that money multiplier so that I have it in my pocket just in case the question needs it for the remainder of the question. So what's the maximum total change in demand deposits? Now, remember, demand deposits, it's a fancy way of saying checking accounts. in the banking system. Now, when we have a deposit, what we do is we take the excess reserve times the money multiplier. The excess reserve times the multiplier, that in this case would have been 80 times the multiplier of 5, that's 400. But this isn't the answer this time because they didn't ask about the change in the money supply. That's actually the answer to A3. They asked about the change in demand deposits. They tried to trick you. Kim deposited cash into the demand deposit. That means we have to include that 100 plus that 100. The answer to this question is $500. So A2 is $500. Now, A3, we can go to our formula because that works perfectly here. When we have a change in the money supply, that's just your excess reserve times the money multiplier. That means that we have 80 times 5, that equals 400. Now, it's getting a little sloppy and a little smashed over there, but if you pause the video when you're solving this on your own, you're going to be able to figure it out and rewind and all that. So the trick to this problem was that A1 was easy, A3 was easy, A2 was a trick. A lot of times students will put the same answer to both because they don't know, and that works just fine. And sometimes that'll save you. But you knew this had to be either 400 or 500, and so either way it goes, you're okay. So now letter B says, and I'm going to make a little line here so that it's not quite as sloppy and we break it up with our eyes. So letter B says, assume that the Federal Reserve buys $5 million in bonds on the open market. As a result of the open market purchase, calculate the maximum increase in the money supply in the system. Okay. What that means is we have to use the multiplier, and we know the multiplier is 5 for this problem. Now, in this case, because it's a bond, our rules are different than if it's a deposit. Remember, if it's a deposit, what we learned is that you take the ER, excess reserve, times the money multiplier. But this isn't a deposit, this is a bond. When the Fed jumps in with a bond, that means they're literally snapping their fingers, poof, and they're producing that money out of thin air. They're printing the money. So we have to take the full bond times the money multiplier. This right there is the biggest confusing thing for all students in this minor unit. Inevitably, students will get confused when to multiply by the bond, when to multiply by the excess reserves. And this is easy. If it's a deposit, you're probably going to use the excess reserves. And if it's a bond, you're just going to use the full value of the bond. This is a fact. So assume the Federal Reserve buys a $5 million bond on the open market. As a result of the open market operation, calculate the maximum increase in money supply in the banking system. Okay. They even said banking system. So this is a change in the money supply in the banking system. That means we have to use the multiplier. Multiplier is 5. We established that a little bit ago. So in this problem, letter B, what we have is $5 million bond, right, times the multiplier 5. That means letter B here is going to be $25 million. That is the answer to letter B. And then finally, letter C says, given the increase in the money supply in part B, what happens to real wages in the short run? Okay, in order to do this, this is, and they do say explain, in order to do this, this is an application question. So this is more than vocabulary. And of this list, this is the hardest part of this, there's no doubt. In order to do this, we have to remember, given the increase in money supply. So let's draw that linking statement. Money supply went up, so we know that interest rates are going to go down. We know that to be true because when we draw a money supply graph, and when in doubt, graph it out, ladies and gentlemen. This always works. This is nominal interest. That's our interest rate. Money supply increased, so we draw the new money supply over to the right like so. And look, we see that our interest rates went down. This visual that we have right here is a very powerful tool at our disposal. When in doubt, graph it out. Embrace the graph, love the graph. The graph shall set you free because often it will show you the answer. What happens to real wages in the short run? Well, money supply went up, interest rate goes down, and that means that investment's going to go up. And ladies and gentlemen, that means aggregate demand is going to go up. Now we're on to something. And if aggregate demand is going to go up, that then puts us in position to solve the remainder of this problem. What happens to real wages? Well, let's apply another graph. When in doubt, graph it out. I am going to find our aggregate demand graph here. And so long run aggregate supply, aggregate demand. This is price, correct? And right there, we have our price level. Here's our current output, real GDP. And then finally, I need to add our short run aggregate supply like so. We just said that we're increasing aggregate demand. Now, check this out. Your aggregate demand increases like so, right there. This is our short run equilibrium. I'm going to dot over. Now, check this out. What happens to prices in the short run as a result of this? Price went up. What that means is that my real wage has to go down in the short run. Think about it. If I make $100,000 a year and prices go up, do I have the same amount of money, more money, or less money? My income is going to stay exactly the same. And if prices go up, that means I'm going to be able to buy fewer things. And so the answer to letter C is because of the change, real wages will go down since prices went up. Now, if you're feeling fancy, you could have used the Fisher formula to solve this. Fisher formula tells us that nominal minus the rate of inflation equals real. My nominal wage stayed the same. Inflation is defined by prices going up. If prices went up 1%, that means my real wage went down by -1%. Now, I made that number 1% up. It could have been 6%. It could have been 0.1%. If that's the case, my wages still went down because my wages in the short run are always going to stay the same. Wages don't change in the short run, if you recall. Wages are stuck. We call this concept sticky wage. If you were feeling really fancy when it said explain over here, you'd say real wages would go down because in the short run, wages are stuck. And since prices went up, real wage goes down after we modify for inflation. That, ladies and gentlemen, is the full solution to the AP exam question from 2009.